If you look at the story of Vodafone Idea over the last few years, the chart pretty much says it all. It was a picture of pure chaos, just intense volatility that really put its survival in question. But then something fundamental changed. A massive government intervention stepped in, and it acted like a stabilizing force, turning all that chaos into a much more predictable, managed path forward. So in this explainer, we're going to break down exactly how that happened, and more importantly, what it means for one of India's biggest telecom players. Here's how we're going to walk through it. First, we'll look at the company's incredible journey, from just trying to survive to actually stabilizing. Then, we'll get into the regulatory lifeline that made it all possible. After that, we'll dive into the big race to rebuild, weigh the bull versus the bear arguments, and finally, we'll look at the verdict and the key milestones you need to be watching. All right, let's kick things off with that fundamental shift from survival mode to something resembling stability. And I want to be clear, this wasn't just some small course correction for the company. It was a complete and total overhaul of its reality. We're talking about a move from the absolute brink of collapse to a new, and yes, still very challenging, path. At the heart of this change is the move from what we can only call an existential crisis to a managed recovery. So what was the catalyst? Well, the government started treating Vodafone Idea as a special case. By taking a massive 49% equity stake, the government essentially created a sovereign backstop, guaranteeing that India would remain a three-player telecom market. This single move has, for now, decoupled Vodafone Idea's fate from its peers, creating an entirely new way to look at this company. This brings us to what is maybe the single most important factor in this entire story, the regulatory lifeline. This is what gave the company the cash it so desperately needed, not just to survive, but to start unlocking some critical liquidity. Now, before we jump into the numbers, we have to get our heads around a key term, adjusted gross revenue, or AGR. Put simply, you can think of this as a pile of historical dues and fees that telecom companies owe the government. And for Vodafone Idea, these dues were a crippling liability, really the kind that threatened to bankrupt the entire company. And here, you can see the real tangible impact of that government lifeline. Just look at this. The company was staring down a massive payment cliff. We're talking 18,000 crore rupees in regulatory dues by March 2026. Now, that annual cash outflow has been slashed to just 124 crore rupees. The bulk of that huge payment is now frozen until 2031. This deferment isn't just a big deal. It's the game changer. It's what frees up an immense amount of capital to actually start rebuilding the network. You know, this structural change is every bit as important as the financial one. The government of India is now the anchor shareholder, holding a 49% stake. The implication here is crystal clear. This creates a sovereign backstop. The government is now a de facto partner. So what does that mean? Well, it guarantees solvency and it buys the company a ton of time. But, and this is a big but, it does not guarantee a return to operational growth. So, with the immediate crisis averted, the whole story pivots. The question isn't about survival anymore. Now, it's all about the race to rebuild the business, and doing it in the face of some pretty massive headwinds. The company's new game plan is being called Vinch 2.0, and it represents a major shift in philosophy, away from pan-India dominance and towards quality over quantity. The strategy really has three main parts. First, they're going to focus their resources on 17 priority geographies where they have historical strength. Second, they're aiming to raise the average revenue per user, or ARPU, up towards that $200 mark. And third, they plan to use AI-driven services to improve customer experience and, hopefully, stop the bleeding of subscribers. And here's where all that cash we just talked about is going. The company is kicking off a massive 55,000 crore capital expenditure plan, or CapEx. It's already locked in $3.6 billion in equipment deals with major vendors like Ericsson, Nokia, and Samsung. This is a huge signal. It marks a critical shift away from a period of just capital starvation, basically saving every penny, to a new phase of actually deploying capital to close that 4G and 5G coverage gap. But rebuilding is a race against the clock. And let's be honest, Vodafone Idea is starting way behind. While its competitors, Jio and Airtel, have pretty much achieved nationwide 5G coverage and are already monetizing new services, Vodafone Idea's 5G is only live in 29 cities, and it's still expanding. This technology deficit, a lag of nearly 2 years, represents a really significant risk. This graph right here, it perfectly captures the central tension in the company's operational story. You see the blue line? That's the ARPU, slowly climbing towards that $200 target. It's currently sitting around $178. But then you see the red line, and that shows a continuous churn of subscribers leaving for rivals. So this poses the critical question: can the network upgrades and better customer experience actually stop the subscriber bleeding before the company simply runs out of time and money?
And that brings us to the final roadblock. This is really the last piece of the funding puzzle. To fully execute its CapEx plan, Vodafone Idea needs to secure about 35,000 crore in bank debt. The problem? Domestic lenders are still in a wait-and-watch mode. And until this debt is secured, the entire turnaround strategy is basically stalled, making this the #1 bottleneck.
Okay, so given this really complex picture, you can see how there are two very different ways of looking at the company's future. So let's break down both the bull and the bear arguments. All right, let's start with the bull case. It's really themed around liquidity and a potential re-rating. It all starts with that AGR freeze, which provides a massive amount of cash flow freedom. Bulls are also pointing to the possibility that the government could actually reassess and reduce the total AGR liability, which would permanently shrink the company's debt. And with bankruptcy risk essentially off the table, the argument is that the stock is now positioned for a valuation re-rating as its ARPU continues to improve. Now, on the flip side, the bear case is all about competition and the risk of just becoming obsolete. First off is execution risk. The banks are still hesitant to lend the money they need. Second, you have the massive competitive moat. Rivals are literally a generation ahead in technology. And third, there are some very real long-term solvency concerns. I mean, if subscriber losses continue, the company might not generate enough cash to meet its obligations when those big payments resume in 2031. So, taking both of those sides into account, let's wrap this all up with the final verdict from the source report and take a look at the key milestones that are really going to decide which path this company takes. This timeline is a great recap of how we got here. It all started with the telecom relief package back in September 2021. That was followed by the government becoming the largest shareholder, a historic funding round in 2024, the first commercial 5G launches, which are expected in 2025, and then that official AGR payment freeze, which is set for January 2026. So what's the final verdict? Well, the source report classifies Vodafone Idea as a speculative turnaround play. What does that mean? It's no longer considered a value trap, an investment that looks cheap but never actually improves, because that immediate risk of going bankrupt is gone. However, it's not yet a compounder either, a company that can deliver steady, predictable growth. This remains a high-risk situation that is entirely dependent on execution. Looking ahead, if you're following this story, there are 4 critical milestones to keep on your watch list. First and foremost is the finalization of that huge 35,000 crore bank loan. Second, everyone will be watching the Q3 FY26 results for any sign that the subscriber churn is finally leveling off. Third is the final government verdict on the total AGR dues. And finally, we'll all be watching network metrics to see if they can expand 5G beyond just the current 29 cities. This leaves us with one final and, I think, pretty provocative thought. The government has secured the company's survival, but its revival? That's far from certain. The question now is whether Vodafone Idea will become a textbook case study in successful corporate turnarounds, or will it become a cautionary tale of a company that was simply too late and too far behind to ever really catch up?